Sandeep Tandon joins us, CA with Quant Mutual Fund. Sandeep, good morning. Thank you for joining us. First, let's talk about stress test. I mean, what has been the conclusion at Quant and what has been your finding?
See, stress test, I will say, let me explain a larger thesis. See, what regulator wants from us is that you should disclose your liquidity position, your risk related data points, your concentration in the large mid, or even concentration from a client perspective. So I think it's a good exercise from a larger perspective, more from a transparency point of view. But if you really look at the way SEBI has defined in terms of liquidities or stress test, whatever they're calling it, is very conservative actually. Okay, so they have taken a very conservative approach that you can only sell 10% of the portfolio in a day. So from that background also, our scores has been pretty good, and we have been very, we look at the liquidity analytics very closely. As you know that we track liquidity analytics not only from India and global perspectives. Obviously we will be very conscious about our own fund also. And if you recollect, for last many quarters, actually last 4 quarters or now, we have been having a significantly large exposure towards the large cap fund in both our mid and small. In fact, current exposure is around close to 28 to 30%, both in mid and small for the large cap. So we have been very conscious about liquidity aspect, and since most of the schemes we don't charge any exit load except mid and small, and so it's a clear indication that 15 days exit load is not much. So we generally keep our portfolio very liquid relative to the industry.
Do you expect that while you have enough and more liquidity safeguards in place at the industry level, the stress test could create a lot of stress?
No, I think it's a narrative which got built actually. See, if you really look at Nikunj, market was rallying significantly right from October when we talked about the risk on rally in the horizon. Market has rallied sharply, so the correction was anyway due. Okay, we have, I will not say we have reached a very hype stage or euphoric stage in the broader market. Yes, in certain pockets there was some amount of hype or euphoria, but if you look at the larger market, I don't see any signs of euphoria. But obviously, when moves are very vertical, it leads to correction, it leads to consolidation. I think we are in that phase. And sometime any event, okay, this time more from a regulatory perspective or the disclosure from the election commission's point of view, for the nation point of view, many news, even some notices came from RBI perspective, many news came together, people perceive as unknown risk suddenly hitting them and then leads to a correction sort of thing. But I think when market becomes slightly overbought and bound to correct, when any news, okay, can lead to this. But this time narrative was slightly different. So we don't find anything unusual in, if you believe that we are in decisive bull run, which I believe. But I also said that in last many months that easy phase of bull run is over, but we are in decisive bull run, but it's a difficult phase. So in difficult phase and even easy phase also, you do see multiple type correction. At least if you look at last 4 years, we have seen on multiple occasion market has corrected 5%, 10%, and even 15% also. I'm not going to be very surprised about it, but it becomes a good buying opportunity also when you see this sort of capitulative move happening, even in some of the large cap names or some of the sector or stocks which we like. So it becomes an opportunity for institution like us to participate.
But tell me, with more disclosures, etc., are we going to see costs rising for mutual funds as an industry per se? And then would those costs be passed on to investors?
No, I don't think so, because this sort of analytics, at least at Quant Mutual Fund, we do it on regular basis. Okay, this is the first time regulator has asked these things more from a transparency perspective. We have our own analytical team. I don't think we have hired any analytical team from outside to do this work. This is actually very elementary work. Okay, which any global house will do it, who is specialized in risk management, will track these data. In fact, whatever data has been asked, I will say it has potential to even improve further. Okay, like small example, people have, the regulator has asked to talk about standard deviation or beta, but the way we look at, or even the turnover ratio, we look at these data points are good, but in isolation. Okay, so you have to look at additional data points. How the risk adjusted measure like Sharpe ratio, Sortino ratio, Jensen alpha, or upside capture, or downside capture. Multiple data points are there, multiple risk adjusted measures are there. if we capture these also, I'm sure a regulator in due course will incorporate these things also in the disclosure. By the way, we anyway disclose this information in our monthly fact sheet. So I think it's a globally it comes out. So I think if we start looking at risk adjusted returns will be far better. Like just looking at P in isolation without looking at ROC or ROE does not make sense. Similarly, just looking at few risk measure in isolation does not make sense. And that's the reason in our disclosure, we have added additional data points also, which are risk adjusted measure, which I just talked about. So it make more sense to disclose that aspect also, because ultimately every investor should know what risk we are taking and what returns he is getting. Okay. So risk adjusted measures are more meaningful rather than just looking at the just unidirectional risk number. So I think it's much better to look at the comprehensive risk adjusted measure like Sharpe, Sortino, or Jensen Alpha type stuff.
Have you seen any redemptions in any of your thematic funds, small cap or mid cap schemes?
No, Nikunj, in fact, I will say I always talked about in last 2, 3 years, the retail has actually become more mature. So we have not seen any our inflow remain as it is. Yes, marginal redemption do happens when these things, but net we are still getting reasonably good inflow. I don't see that 1 day data or 2 day data should become a benchmark. And I always said that retail is much more mature. Any down day, the actually allocation increases, and any a sharp up move, people tend to redeem at that point of time. I think the whole perspective or narrative which we have talked about retail has changed. I think retail is much more mature than the family offices or even the ultra HNI. They have far bigger patience. Their perspective has changed about India and about the saving. So I don't see there will be any impact on the SIP also. I don't see any bigger impact on the industry on the redemption side, because if you really look at in last 4 years, at least 4 or 5 times we have seen some bigger fall like this. And March is a typical month because of year end related stuff. People tend to unwind their books. So we are familiar with this February March phenomena. It happened last year also. So I don't see retail is panicking, and so far none of the data points are suggesting anything that we need to be worried about.
Morning. What about the view from distributors as liquidity is expected to come down in certain MF schemes?
So I think the way I will look at with the regulator asking for these data points on every fortnightly basis means that incremental flow, okay, because you can't do much from the existing holding which you have, but the incremental flow, particularly in the mid and small caps, will now move towards more quality names and more liquid names. Okay, so because if you let's say add any illiquid names in your portfolio, so it will distort your data points. So logically, most of the houses, fund houses, will be looking at more liquid names in their portfolio rather than buying illiquid names. So there could be a bigger impact on the IPOs, okay, because all these IPOs come initially smaller ones. I'm talking about particularly the liquidity is relatively low. So we have to be very cautious in looking at the data from a liquidity perspective, less from the valuation perspective.
Okay, you have a PSU fund, and that's where the knock has been the highest. What's been your strategy there? I mean, are you deploying at buying more PSU stocks on every decline?
See, first of all, it was the last fund which we launched, so we have not deployed even full money. I think we are around 46% deployed. 54% is yet to be deployed, and we have time to do that. Uh, as far as broader outlook, Nikunj, I always say this decade belongs to value as a thesis. Okay, and it's a very classic example. If you look at from September 2020 when till now, also value as a thesis has done very well related to growth. Okay, and so is the case with always the example about Japan also. Japan has been one of the biggest value stock, and it's trading at all-time high now. So now PSU obviously is a part of a value basket. Now, if I look at PSU also in isolation, let's say, I think the narrative has changed. Okay, in last many years, people used to have very negative view or biased for PSU not to buy. But the way incremental, if you look at the allocation within the mutual fund industry, within the FI, actually rising, despite this sector has been grossly under-owned for last many years, or maybe I'd say maybe for 1.5 decades, the participation in this space is hardly anything. It is actually rising because last time also explained about on your channel that how the governance aspect on the board is improving, how the capital allocation is improving, how the perception for India and perception for PSU is changing. And something has already changed, and I believe it will change further. So I think it's a re-rating story for the sector, not about just earning aspect alone. In fact, we remain very constructive about Made in India campaign or India Shining campaign, what we're talking about. India-centric company, when you talk about opportunity, these are public sector are some of the public sector are very unique. They have monopoly status in particular area like railway or defense. So I don't think that one should be get panicking or paranoid about it. Market has corrected. As an institution player, we believe any great buying opportunity obviously comes only after meaningful fall. So as an institution participant, people will be participating and looking for buying opportunity. And the good part, Nikunj, about most of the PSU, the large cap one, they're fairly liquid. From the liquidity point of view, when you talk about whether the metal stocks, whether talk about defense stock or even the oil marketing companies in general, I think are fairly liquid. So from the concern, biggest concern which people have now going forward at the impact cost is rise, you have to look for a liquid names, and PSU fortunately qualify for they are fairly liquid.
Your fund in between one group has about 18-19% exposure. Just two stocks made for about 15 to 18% of your AUM. That's Reliance and Jio. Isn't that a concentrated risk?
So, Nikunj, as a house, we are a very data-driven house. We are analytic house. Okay. So obviously, I am not a great believer of well-diversified. Extraordinary diversification also from a mathematical perspective means there's no control on the risk. Okay. Now, when we talk about concern, yes, we do take concentrated bet, but concentration bets comes from the data. The conviction comes from the data. So it's not a gut feeling call we take that this is area which we like to aid. If you recollect maybe 1.5 years back or September 2021, we took a very sizable bet in ITC also. It was 8-9% or 10% of the portfolio, most of the scheme. And we sold off and switched towards Reliance as a publicly disclosed portfolio. So we are very constructive on the energy as a basket, obviously. And when you talk about even from the telecom sector, retail perspective, or the green energy perspective, it qualifies very well. And as far as Geo is concerned, we have been very vocal. We sold all our NBFC and shifted towards one name in our portfolio. It's a decadal call, so it's not a call which we have taken for a few months or few years perspective, because we believe something will change the way banking is done in India today and globally also. So all the digital centric or the NBFC, which is focusing more toward digital, should be way forward as a trend has been established globally. And I think India is very much in the driving space in this space. So I think it's a strategic call, it's a conviction call, and it's a decadal call for us. So and it's paid off very well. Both the stocks have done extremely well. Another couple of large market cap companies have corrected 25-30% corrected or even 15%. The stocks have given 30-40% Reliance, and maybe Jio has given actually from the lower levels maybe 50 to 80% returns.
All right, Sandeep, appreciate your time. So glad you could join us. And whatever we've gained yesterday, 50% is gone. That's